Walmart earnings last week were fine, basically, but the problem was the guidance, and that hit the stock pretty hard. I think there are some clues in there about the state of the American consumer. We're going to talk about that and take your questions today on Open Interest. Hello everybody and welcome. I'm Mike Coe. Welcome to Open Mike. If you were watching last week, you probably noticed that Walmart didn't fare so well after they reported earnings midweek. It traded down about 6.5% the day after they reported. I think they reported in the pre-open, and then it fell another 2.5%. Admittedly, it was a weekday on Friday, so a lot of stocks were hard hit. I have a chart up here of Walmart right now. We can take a look at how it's done over the course of the last year. One of the things I would quickly point out in all of this is that the stock, if we take a look, still has done all right for the year. It just was actually one of the top 30 performing stocks, I believe, in the Russell. It was up about 15.5% going into the print, and it gave back most of the gains that we saw on the year. So a lot of people like to look to Walmart to identify whether or not the American consumer is in trouble. Canary in the coal mine, if you will. Now, where the stock basically ended up getting punished was because during the conference call, the company, revised expectations essentially for full year on year sales growth. The street had been hoping for numbers in and around 5% or so. The company's guidance suggested that number is going to be closer to 3 to 4%. Now, if inflation is running at about 3% and you're getting sales growth of 3%, that's no growth at all in real terms. Now, a lot of people have been suggesting this is associated with tariffs and things like that. I would actually suggest that, the concern we have based on things like auto loan delinquencies, credit card balances, which the Fed had released some data on that, which showed that it was at about 1.2 trillion, which was an all-time high. So the rising delinquencies and the high balances and revolving debt, those two things were taken in conjunction along with this rather disappointing sales guidance to suggest that American consumers are not in great shape. Now, Callie Cox, who is, she is a contributor for Business Insider, I think. She previously was a reporter at Bloomberg. I've followed Callie for some time. She's now the chief market strategist at Ritholtz Wealth Management, which is Barry Ritholtz and Josh Brown. So if you have followed CNBC in the middle of the day, you probably know who Josh Brown is. He's one of the better known pundits, stock market pundits out there. I'm an acquaintance of Josh's. I haven't seen him in a number of years. He used to do a lot of fast money. I will say, I think highly of Josh. They have a fairly systematic process over there, and I think highly of Callie as well. She sent this post out, I think it was over the weekend, and was pointing out that from her perspective, the $1 trillion, and it's I believe 1.2 trillion actually, in credit card balances isn't as scary as you think. And she put out a series of tweets which, I can't remember what she was calling it, the forgotten denominator or something. And basically what she was pointing out was that if credit card balances are rising, but individuals' cash balances in their checking and savings accounts are also rising, if their incomes are also rising, then that isn't such a scary prospect. Now, of course, there is some truth to that, and this isn't a knock on Callie, but it is true that a data point by itself is not that helpful. What she then did was she took the savings, the credit card balances, and divided it by the savings and got this chart. So over the course of the last 20 years, you can see that credit card balances as a percentage of household deposits has been shrinking. But as is ever the case with statistics, what they don't show is often a little bit more important than what they do show. And her statistics here don't really tell the tale in my point of view. Again, I think highly of Callie Cox. I think highly of the folks at Ritholtz Wealth Management. But frankly, they're missing the plot here. And the reason is, of course, that you cannot simply aggregate household deposits and household credit card balances and assume that these apply to the same group. So what I have here, actually, is a chart of the excess savings for the top 10% of earners, which you can see exploded during the pandemic and has essentially remained at a very high level. Savings for the bottom 90% of earners also exploded during the pandemic because of transfer payments and because businesses were closed. They weren't spending any money. But then, of course, they did start spending money once again, and inflation started biting into their budgets mightily. And what we can see is that virtually all of the excess savings that had been accumulated by the bottom 90% of earnings, most of that is now gone. And so when we look at the average credit card balance of, I think, $6,380, when we look at the average interest rate, which I think is about 23.5%, we can't divide it by the deposits of the top 10% because those aren't the people that are carrying those balances. Now, one could look at this from a positive point of view and say, well, we are depending very heavily, and this is an article that was in the Wall Street Journal. I believe it was today. I read it today anyway, so I believe it was published today, but it may have been published last night. You can find this article yourself. What they indicate is that about 47% of consumer spending at this point is actually from this top 10% of earners. And among the things that they're doing is they're buying a lot of consumer discretionary items, luxury goods, things like that. And the good news about that, of course, is that they have the financial wherewithal to do that. The bad news is it is discretionary. And if they decide to rein that in, then that's going to create some problems. And the rest, the 90% of the population that this gray curve represents, don't actually have much excess. So they can't fill in the gap that the top 10% are spending if they should slow down their spending. So I wanted to simply offer that as sort of a follow-on to my belief that most American consumers are in some distress. And I think I did mention this last week. I had created a chart about this, but basically the gist of it is this, and let me see if I can find that chart, because I don't think I had saved it. Let me see. But I had sent it out in Twitter. If some of you follow me on Twitter, you probably will recognize this or have seen it. But I can just recite the statistics because I happen to remember them, for the most part offhand. And that was that the median income for Americans over the period from January of 2017 to January of 2021 had increased about 15.5%. Just using round numbers, I think it was actually a little bit higher. And the net CPI index had increased about 7.8% or thereabouts. Effectively, the real incomes for the median household, the median worker in the United States, rather than the mean, because the mean is skewed. It's going to, people who earn a lot more, they pull the statistics up. You think about the average net worth in a bar, and then Bill Gates walks in. The mean, the average, doesn't tell you a whole lot. And so it is true when you think about incomes. And over the last 4 years, for a significant demographic in the population, the median income actually rose less than the CPI. So, you're talking at that point about people who are not seeing their quality of life improve. So now, in the midst of all of that, whoops, let's bring this back. Where did I drop that? So in the midst of all of this, I think that the thing that we ought to be thinking about when we look at names like Walmart, and, I wrote an article, I put it out on the Options Edge website. I also put it out on CNBC Pro for those of you who are subscribers to that. But if you are not, I can give you the gist of it, and that's what I'm going to intend to do here. And that is that, Walmart has seen some respectable earnings growth, some respectable I'm going to get rid of the price here. We're going to ignore that for just a moment. And we'll just take a look at the increase in basic earnings per share over the course of, let's call it the last 5 years. Let's look at this for 5 years. And we'll look at revenues per share. I think I have that in here. There we are. Okay. So I'm going to just get rid of, and we're going to go look at this on a panel by panel basis. So first of all, what we can see is that, we've seen a respectable growth in revenues per share over the course of time. Now, bear in mind, so this is kind of an important consideration, and this is sort of where buybacks and things like that come into play. That is that the revenues that I'm showing here, the earnings that I'm showing here, are on a per share basis. So if the company is buying back shares, which has a net accretive impact, what you could see is you can see that revenues may grow faster on a per share basis than they would if you were simply taking a look at the company's financial statement. So, when you think about it, if you bought a share and they're buying back shares and they have decent free cash flow and they're using some of that on things like buybacks, this is effectively what's happening to you. Now, you still care whether the company is growing. What I would tend to look at in this context is, as I've often said, I want to see that the top line of a business is growing at least as quickly as GDP or inflation, whichever is greater. To my eye, if a company, especially a company like this, is not achieving that, then in real terms, they're shrinking. And Walmart is giving up market share to companies like Amazon, for example. In fact, I believe that it's going to be I don't know if it's 2025, but certainly by 2026, the revenues at Amazon are likely to exceed those of Walmart for the first time. Okay. So as we take a look, and you can kind of see that if we look at this. So if we're looking down here on the revenue side, you can see that the blue line is converging. This is on a per share basis, so we're looking at 700 billion-ish in revenues in both cases, and Amazon obviously has some other supplemental things going on in their business, secular tailwinds impacting it, like on the data side and AWS and all the rest. But you can see obviously that Amazon is growing more quickly than Walmart is, but Walmart still had very solid revenue per share growth. So this is net of any corporate actions that should affect the share count relative to their operating results. 7.63% compound annual growth rate on the revenue side for Walmart over the course of the last 5 years. Okay, so then if we take a look at the earnings side, there you see about 7%. Now, that would, if you were just looking at charts and you didn't know the actual numbers that are underpinning this, that might be a little bit worrisome, because one of the things it might suggest is that, perhaps their margins are compressing. The margins have expanded and compressed and so on. The forecast right now is that their net income margins are actually going to broaden a little bit. I think the expectation for the year after next is 3.2%. It's running about 3% now. They have been substantially higher at times in the past. Whatever it's worth. But, yeah. So 7% still better than inflation, better than GDP growth. We like this. This is probably lagging S&P earnings growth by a little. I think that's just under, if you can believe it or not, just under 10%. It's been a pretty extraordinary period. Meanwhile, the compound annual growth rate for Amazon's, as you can see, 52.6. And this becomes important in a second, because I was actually going to compare this to Costco, because I think, it's not that Costco's quite the one-stop shop that Walmart is, but they're a grocer, they sell goods and so on. But, maybe Amazon's a better sort of, it's not a direct competitor in some sense, but it is an alternative. When Walmart is losing market share for anything that they happen to sell, there's a decent chance that Amazon is where a good percentage of those sales are going. Now, this is the really important chart to me. which is that I've just illustrated that the revenues at Amazon are growing much faster, almost 20% compound annual growth rate. The earnings are growing much faster. But check this out. The valuations of these two businesses have converged. And one of the things, of course, is that Amazon has grown into its valuation. That's part of it. The other part, though, is that, and I really need to take Amazon out of here so we can really get us. I mean, Amazon at one point, their earnings were almost non-existent. People valued it as a multiple of EBITDA because they said at some point the company can turn on profitability. They just can, move a couple levers, turn a few knobs, and then suddenly they're going to be massively profitable and be generating huge amounts of free cash flow. Skeptics kind of dismiss that idea, but they've demonstrated that, yeah, in fact, that's actually true. So we now see that they absolutely are doing this. But I'm going to get rid of Amazon for a second. And the reason I'm going to do that is because I kind of want to let everybody see this picture here, which I think is pretty extraordinary. And that is that Walmart was trading 20 times earnings about 2.5 years ago. If you go back even further, what we're going to see is that it was actually trading about 3 turns cheaper than the S&P was. I mean, look back here. It was trading 15 times, but even in this area, like 7 years ago or so, thing was trading 17, 18, maybe 19 times earnings, even as the S&P was trading 20 or so. Now it is trading 39 times trailing, 34 times forward. And I think the company is doing a great job from an operating perspective. I want to just, mention that to begin with. I think they're doing a very good job. They have really been investing in and evolving their supply chain and logistics, things like that. Bringing groceries into the stores has proven to be a very good business. It's not a high margin business, but it was a good strategic move because it brings customers back again and again. If people get used to buying groceries at Walmart, that's just going to bring foot traffic in. They might wander around the store, pick up some other things. So that is obviously good. And their e-commerce is doing quite well. So, it's not Amazon, but, they are making meaningful traction in that area. So I don't want to be critical at all of their, of the company's operations, but I am pretty critical of this valuation. I can't get my arms around this. The company is not going to, what would be reasons that you could justify a valuation this high? Well, one would be that you think that the margins are going to expand considerably. And when I say considerably, I'm not talking about 50 basis points. Just to get in line with the S&P, the thing's got to come down by a third. So you're talking about getting net income margins up in the 5.5% range. That doesn't seem likely. Whether tariff concerns are overblown or not, we're not going to get back to those levels. It's a competitive business, and this is a very price transparent marketplace. And in fact, actually, it's interesting, and I'm sure most of you know this. Most of these businesses have some kind of price matching, and it doesn't take much to go on your smartphone and find out what something costs. I had to replace this. I had to get another printer. I have one that's sitting over here on the box that it came in because I'm not sure I'm going to keep it or not. You can probably see it in the background there. And, my wife, knowing that I had to run out on a weekend and replace this, because we have another printer, but she said, oh, you should go to, and she made some suggestion because they have good prices. I said, it doesn't make a difference where I go. I go to the closest store because all I have to do is go on my phone and say Hewlett-Packard Laser Pro whatever, and I can get it for this price. Almost everybody price matches these days. So the idea that you're going to see big margin expansion in an environment like that seems highly unlikely to me. So where does that leave us? My thinking is that if you're inclined to sell some upside in Walmart, sell some upside call spreads. If you own the stock and don't want to sell it, particularly if you have tax considerations, I get it, right? The company is still growing, albeit not as quickly. They are operating well, but I do think it's a little bit pricey. You could look to sell some upside covered calls, 20, 25 delta, something in that neighborhood. And I think that makes sense. Costco too, by the way. I'll just pull that up here. Another company that I think they do a great job. They also have seen some remarkable growth, as you can see. I mean, if we get rid of the price to earnings right here, so if all you had to do was look at these two things, you would be ecstatic about this business. I mean, this is a 10-year compound annual growth rate in the basic earnings per share. So remember, that's net of any corporate actions on the share count and so on. That's about 14%, and 9.5% compound annual growth rate on the revenue side. The big problem is this number, and that is what you're paying for it. Right now, it's almost 54 times. And to me, it's just really hard to get behind that, especially when the S&P is trading at 20. I'm not saying the S&P is cheap at 25 times. It's not. But it is a heck of a lot cheaper. And, the analogy I like to try to give people ways to think about it, because if anybody was watching Fast Money last week, I think it was on Friday maybe, Karen... apparently Karen is supportive. Karen Feinerman is supportive of Walmart. I think the world of Karen also very, very smart, very thoughtful, really digs into things. So she's a smart, deep dive, and she's a value investor too. But I got the sense right before I went off the air that she likes Walmart. I didn't get to hear the rest of her points about it, but at this valuation, I just simply can't get behind it. And this is the way I like to think about it. Imagine that you were in the lumber business and you could go out and, you had a certain amount of money and you could wander out into the forest and you could invest in a tree. And you go out and you start looking at the trees and you find this big tree. It's tall, it's straight, it looks healthy, all is good. And you say, well, I want to buy a share of that tree. And the guy says, look, you can buy a share of that tree, or you could buy a share of all of the trees. And, just for good measure, I'm going to let you know that, the board feet for all of the trees around here are increasing at about 10% per year. And, for this tree that you're looking at, it's growing at about 5% a year. And I'm going to charge you 35 cents a board foot for the single tree, or I'm going to charge you 25 cents a board foot for a share in all the trees. Well, it's a no-brainer, because you're getting faster growth, a cheaper price, and better diversification. You're getting a share in all those trees. So if something disastrous happens to the one big one, that doesn't impact you. So to me, this is kind of, and I apologize if that seems like an overly simplistic explanation, but I sometimes I listen to very, very smart people talking about things, and I think, am I missing something, or are you missing something? Callie, smart person, think the world of her, but you can't look at credit card balances divided by aggregate savings when rich people have savings and 90% of the population have none. And you can't look at the value of a business in isolation when you could buy a share of all businesses and get faster growth, better diversification, and pay less. It's just like picking up your phone. Price match. You get the best deal. The best deal is not Costco, and the best deal is not Walmart. Okay. So with that, I figured we could just take some questions. Bob, is Google forming a bottom around 180 or more pain to come? Thoughts on a calendar spread, 190 May long calls, 200 April shorts. Well, let's take a peek. First of all, I like Alphabet. I like Google. What I say about Google applies equally to the voting and non-voting shares. Doesn't really matter to me which one you choose. When I was running a 40 Act fund, we have certain, you have to be really diligent when you're running a a 40 Act fund like a mutual fund or actively managed ETF, something, an SEC registered investment vehicle. You have to be really diligent about things like your proxies and votes and things like that. So actually, from an institutional holder's perspective, sometimes it's, your vote's not really going to count anyway. Sometimes it's more convenient to have the non-voting shares, believe it or not. You would say, well, why? For the same price would you ever hold the non-voting shares? But in general, for everybody else, I think you're probably better off just getting the voting shares. I mean, you don't have a compliance problem. Who knows? Maybe you want to vote. It makes you feel good, or maybe you have a ton of stock. I don't know. And it can make a difference. And, somebody puts up a slate for the board of directors, and you want to have an input. So all else equal, unless you have compliance issues that compel you to deal with the voting, and that becomes a tracking nuisance, probably GOOGL. I like the company. I like the valuation. I like that they have a lot of secular tailwinds. The things that are a little bit difficult, of course, are going to be ad spend. That's one of the things that could be a potential concern. Antitrust issues and, other types of government intervention, regulatory fines, Europe and in the United States. And that's always an issue with some of the largest tech companies. But I think it's still justifiable. So with that, I like the stock. In fact, I like it enough that it was part of my, and not a helpful one, it was part of my acronym for 2025 Rising. So it was the G. So for those of you who are watching, you know that I had one with 2 Gs and one with 1 G. CNBC would only let me have 1 G, so that was Google. But for you viewers and for people that subscribe to the Options Edge and so on, I had 2 Gs. The second one was for GLD. So I was only using things that traded like an equity. So I used IBIT for Bitcoin, GLD for gold, and so on. But I do like it. So let's just take a quick peek then at your calendar spread. Oh, you know what I need to double check too is, and I'm assuming, because I don't know right off the top of my head when their earnings are. Okay. So that's the reason. Makes sense. You're looking to get short the options that are not including earnings, and then long the ones that are, which I think is the appropriate course. I might stretch out the long side a little bit more, and what I'm about to suggest, look, I mean, this is going to depend a little bit on what the capital requirements are. Everybody's circumstances are going to be a little bit different. I mean, I'm comfortable owning the stock, so I wouldn't even mind being short a near dated strangle. So basically a diagonal call spread risk reversal against that longer call would be totally fine with me. What might something like that look like if I was going to do it in May the way you have done? So you were long the May 190s. Let's have a quick peek at what this, go to a mid market, and then short the 200s, 200 calls, which are a 16 delta. Yep, makes sense. These, the 195s or the 200s either. So 23 delta for the 195s or 16 deltas for the 200s. That's a buy, that's a sell. There we go. And then if you were looking to say sell a comparable. Okay, I've been told that the screen share is lagging a little bit, so I'm going to try to move slowly and see what's going on here while we sort that out. But you might sell the 165 puts against it, so you end up with a structure that looks a little bit like this, and I'm going to leave that up until it pops up, because I can see that our software, which is imperfect, admittedly. So I'm watching now I'm not moving my mouse, and I'm watching my cursor move around the screen. So that's not very helpful. But yeah, I would be comfortable with that strategy. Just make sure that you make an adjustment before earnings comes along, because there's going to be some meaningful vol crush. Something else you could consider, by the way, is wait until those Aprils have 2-3 weeks to go, and then adjust the whole package at that point. And, you know, you might even be interested in getting short the maze at that point, frankly. One of the things you're going to want to see is, okay, what's the implied move? We'll take a look at that right now. So just going in here, we can take a look at the at earnings for Google historically. And I'm just going to bump this out to 12 quarters. So it's a little early right now to make a determination. So it seems like, yeah, it seems like the screen share is working out all right here. And oh, by the way, if you're looking in this right-hand corner, you can see one of the reasons why I like Alphabet, right? So decent operating results, typically coming out on the high side of the number, solid earnings and revenue growth. This is a very cool chart, by the way. I haven't seen anybody else do this. I'm sure some others do. Maybe you guys can share it. But what you can do here is it will show you relative to earnings, where you are right now, how the stock is doing compared to the last 2 quarters, 4 quarters, 8, 12, whatever. And it'll identify when earnings were in the past, and how the stock performed going into earnings in the past, and how it's behaving now coming out. And I find this to be, you know, really interesting. So you can just sort of get a sense of, you know, is this thing outperforming coming into the print and underperforming coming out? That was the case here in Alphabet. If you take a look, you can see that the performance, I don't know if you can see right up over here. Yeah, I think you can. All right, yeah. So you can see that the average was up about 2% the day before earnings in the 20 days prior. And this time it was up 7.6%. And the interesting thing is that if you take a look at the move that's happened after earnings, essentially what has happened is net, it's, kind of, it reverted back to where it was. This was kind of true for Walmart too. And again, I apologize if this is going to be a little laggy. Doesn't look too bad. So this was the 2-quarter move, but let me just, I was looking at this. This is when I really started to look at it because I thought, well, that's kind of interesting. That, and what you found was that a big part, a significant, 70% of Walmart's decline, there was a little bit more disappointment than that, but about 70% of its decline was simply reverting back to the performance that the stock has traditionally exhibited. I mean, I'm going back 8 quarters in this case, but that is more in line with how the stock has behaved. So whatever over-exuberance existed in the stock going into the print, this is kind of a nice way to visualize that. So I think somebody here was just asking about NVIDIA. And so short version is, like Google, like the calendar, would think about a diagonal call spread risky if you don't mind being short that put, the 165s. Okay, so this defaults to 2 quarters. I'm just going to bump it up a little bit more. Now we're looking at NVIDIA. And I'm just going to hold off here. I'm just going to make sure we have that. So we have to talk about NVIDIA earnings. I'm trying to come up with a trade that maximizes probability of profit. I think NVIDIA will beat and raise, but not enough to make it take off to greater than 150. So that means, among other things, you'd probably be able to sell the 150 strike, right? So let's take a look at the implied moves. This is from the last 8 quarters. Let me bump it up to 12. And you'll forgive me. I'm just trying to make sure you guys see what I see. There we go. Okay. You can see that the implied move is actually pretty big here, right? So it's bigger than it was last quarter, smaller than 2 quarters ago, but then bigger than this, bigger than that. So it's actually, the implied move is slightly above average looking back the last 12 quarters. I'm with you. I suspect that, okay, I'm going to just take a quick peek here. So you have another Also don't see it falling significantly. Oh yeah, you had a follow-on. Okay, so yeah, let me share that too. So in addition to, you think, a beat and raise, not going above 150, we see an above average implied move. And when I say above average implied move, I'm just looking at the last, well, I'm looking at a 12-quarter period, this being the 12th, and the earnings aren't out yet, but you can see that the implied move for this, the 12th of the 12, is bigger than most of the preceding 11. I, too, feel like the upside is probably a little bit mitigated. By the way, and you can kind of see here, these X's identify those moments when the stock moves significantly more than the implied move was at the time. And in every instance, that was to the upside. The most recent 2 quarters, not so much. So, what might one trade with the expectation that you have? So you think the implied move, which is about the straddle, well, let's start with this, right? So let's just say you're just trying to flip that coin from now until the end of the week. The implied move being somewhat bigger than has we've seen on average. There's some instances when it was bigger, but in general, the average is less. So if I was just going out to the end of the week, I wanted to buy something at the money, well, sell that 150 call, although the 150s don't really have that much juice in them, do they? But we're just going to put this in at the moment for the sake of argument. 89 cents. I want to get at least $1. So I'll put that in. And if you think it's going to be a $13 move, so that's going to take us down to, 117-ish on the downside. One could look to do, something a bit like this as a way to make a bullish bet. So selling that upside call and the downside put in this instance is going to cut 40% of the cost off of it, get a structure that looks a little bit like this, call spread risk reversal. I don't think it would be a terrible idea to contemplate going out a little bit more than that if you wanted to. Try to take advantage of some vol crush. And, there's going to be more premium in some of the longer dated stuff. So if you push this out a little, I'm going to just make it 115 and 150 now, just so that we have nice round numbers to work with, like this. And, as you go further out in time, one of the things you're going to observe is that this is going to get to a point where it's essentially going to be no net premium. And then you're going to have, call it $20 worth of upside. You'll skip the first $15 worth of downside risk. One way to think about this, which I think is a decent way to think about it, and that is that if the stock falls, let's just say it fell 20% from where it is right now. 20% from 130-ish is a $26 decline. If you short the 115 puts, that is going to take it to 104. You lose 11 at expiration, right? That's one way to think about it. So $11 over 130, you're really, that's kind of your downside risk. That's a way to think about it versus, the $26. So you've essentially cut your risk in half. If you think that's the magnitude of the downside move. So I'm being told it's still catching up. It's just getting to the 10-15. Okay, so yeah, I apologize for the lagginess. We're going to have to do a little bit of diagnostics on what the issue is there. But, yeah, I'm going to leave this for a second. And I'm just going to look up there. And I'm going to bring up another question. Okay, I have several speculative bearish positions in Palantir put on in recent months. What are your thoughts on the current trend in the stock? So, first of all, I'm just trying to see whether you all got the last sort of version of that call spread risky for NVIDIA before I make the change.
Yeah, move on.
Yeah, it looks like okay, good. So we will make that shift. You know, the issue with Palantir, and I think I've said this before. This is a business that, you know, I like what they're doing. Very, you know, it's really interesting stuff. But this is another one where the valuation is pretty tricky. And I mean, first of all, I think you were right to make a bit. Well, clearly you were right. I mean, the stock's obviously had a couple tough trading days. Oops, what happened here? I thought I was putting in a 1 month chart, but let me go back to the overview. There we are. So it has obviously been pretty hard hit. It's still far from cheap. I mean, this was a name that was trading at, what did we say? I think when we were looking at this a week ago, like 60 times sales. In a critical area, I believe they are working in conjunction with Anduril on the EMP anti-drone stuff, so they're on the software side and Anduril is on the hardware side. Very, very slick, very cool things. But it is a risky spot. What makes it riskier is that if you can imagine that you're trying to cut government spending, one of the places you might look to do it, even if you're friends with the founders, would be in contract stuff. And, you know, also Hegseth had pointed out, I think, that they were going to do something like 8% year-on-year budget cuts for the Department of Defense for 5 consecutive years. It's a little ambitious when you say, okay, well, that assumes you're going to be here in 5 years, which probably is significant questions about that. But yeah, I think this is the trend for Palantir is not a great one. So, although I would adjust, I don't know what your bearish bets were. Think about adjusting, rolling, that kind of thing. Yeah, we're looking at, I mean, it's not meaningful support here. You've got this unfilled gap. So, yeah, there's potential for another 20% decline. And if the market starts to show some significant weakness, this is a high beta name. This is going to be among the ones that are going to experience that kind of thing. All right, so Alex V, you just asked about NVIDIA. I hope I answered that one. Now, actually, you know, one of the things I did not bring up, which I think is very reasonable, there is the pigs in a python risk in NVIDIA, which is to say that, you know, there's a huge build out going on right now. If you thought this was going to last forever, this stock would be, you know, one of the buys of the century. I mean, take a look at what the estimated numbers are for the next 12 months. $4.43 a share on a 50% earnings growth rate. If you thought that can, or if maybe you do think, but if you thought that could keep up indefinitely, to get 50% growth for 29 times next year's earnings, next 12-month earnings, and that's a no-brainer. It's not grossly expensive if you think that can last, but it's not priced as if people think it would. If they thought this could last, the stock would be honestly 80% higher than it is right now. Right? Because that, you know, just think about it. PEG ratio of 1. So, you know, that would mean it should be trading 50 times earnings instead of 30, 60% higher. Right? So, that would take it comfortably over $200 a share. If you believed that this kind of trajectory could last for at least just a few years, that would be a justifiable number. But it's not priced like that. And I think, you know, people are still wondering, you know, they're a little bit shaken by this Deepseek thing. Maybe there will be other technologies. Maybe you don't have to invest quite so much. Maybe quantum is closer than we think. All of those things are risk factors. I believe, I think, what did Microsoft say? They still are suggesting we're several years off. But, you know, they're making meaningful progress, according to Satya Nadella. So, anyhow, I think we're probably going to get a good number out of it because, we're still in the hockey stick part of the growth curve for the build out. It'll be interesting to see what they have to say about the future, though. Okay. What does SVOL have? What role, does SVOL have in a portfolio? It earns income by selling VIX futures and has a 16% dividend. Is it a decaying asset, or can it be safely held for months or years with dividends reinvested? So one of the things about selling, let's talk about this. There are a number of ways that people try to sell the volatility risk premium, and there are a number of ways that people try to capitalize on the decay in strategies that trade rolling futures. So I should probably chart this first. So what you're looking at right now is I'll try to highlight this, see if I can make it a little fatter. I don't know. It looks like you can see that all right. What this is a chart of VIX futures. So all of the VIX futures going out in time, and the market's in contango. That means the back months are trading at a premium to the near months. And if you had a strategy that would buy, let's say, the front month future, and then as expiration maturity approaches, you rolled and bought the next one, and just did that again and again and again. If the prices, all else equal, if the prices don't move that much, you're always going to be paying up for the subsequent future. So however many of them you own, you're going to, every incremental purchase is going to be fewer of them for every initial dollar invested, if that makes sense. So if you can think about it this way, imagine that you had some instrument that cost $1 and you invest 100 and you buy it, and then after a month it's worth 99, and you have to buy the next one and it's 100. Well, you're $1 still. You're only going to own 99 of them, and then that's going to go down, from 100 to 99. So you're going to once again lose 1%. Next time you can buy, 98 and change, and so on. So that's the decay. Another way to think about it, though, is that for everything that you do where you own vol, there's going to be some decay. And you can realize that decay in different ways. If you bought puts, they're going to decay away. And if you buy the VIX futures, they're also going to slide down the curve. Same thing. So the flip side of that is, well, why not just always do the opposite? Okay. It's true that there can be some meaningful value that accrues to the holder. But the problem with that is that there is some negative skewness. So when you suddenly get a big spike in volatility, you can get really big drawdowns. You can see one here, for example. Now, this is not totally representative of your returns because, to your point, you have to think about this in terms of dividends. So if we take a look at it inclusive of dividends, then you get this orange line, right? So you don't want to buy the white line because all of these derivative strategies, they just tend to bleed out a little bit. But this one pays you a dividend, and so here you get some sense of it. So the 1 year total returns inclusive of the dividends, so the price was down 8%, but net of the dividends, you made 7.6%. But the problem that you get is that you have these drawdowns like this. And think about what does this payoff behavior remind you of? Well, it reminds you of selling puts, right? You collect a little bit of money, and then you get, punched in the face because the market has a drawdown. And then you collect some money, And if you can hold on, you can earn money doing this. Is it super exciting money? I don't know about that. I think if you can strategically pick stocks and sell strangles as your effort to collect premium, sell puts and stocks that you want to own, things like that, I might favor it, and hopefully you're going to get total returns that are a little bit better than this. Because remember, as I've said in the past, if you're going to take an equity-like risk, you want an equity-like return. What's an equity-like return? Well, over the very long term, 8% is probably not unreasonable. But in recent years, the returns have been considerably higher than that. And so I would suggest that this is lagging. And let's just also, we're not going to go too far down the rabbit hole, but I want you to just give some thought to this aspect as well, which is that this drawdown here, which took place over 14 trading days, was 12%. So that is an equity-like risk, right? 12% drawdown in 2 weeks, or a little bit more. I don't trade it for what it's worth. I don't know if that helps you at all. It's not hugely exciting to me. But this is what you're going to get, this orange dotted line. The orange dotted line reflects what you get, total return net of dividends. Let's see, maybe I'll blow this up a little bit more. I don't know how long this one's been around. Okay. These little D's obviously indicate when you got the dividend. So, pretty steady. Yeah, the longer term returns are actually a little bit better. If you reinvested the dividends, you're looking at about 9% per annum. But again, look at the drawdowns, right? You can see this was down at 24. This was, where were we here? 28. So that's about a 20% drawdown here, which, you can decide for yourself whether you think that's appropriate relative to the risk. Okay. Steve Grishy, I was thinking about a March 110, 150 Iron Condor. However, I don't think Iron Condors perform well when there's a big catalyst before expiration. That is true. Well, here's the thing, right? So selling premium into something like earnings, I don't mind doing things like strangle swaps because it mitigates the risk a little bit. But the fact is that, a lot of research has shown that selling premium into the event without owning something else isn't necessarily such a great do. But as we saw when we were looking at the implied earnings numbers in here, we could see that, we're making our own subjective judgment that we think that this quarter's move might be smaller than some of the larger ones that we've seen in recent years, which would include what happened in the first quarter of 23 and the second quarter of 23, and then similarly the first 2 quarters of last year. By the way, not for nothing, but this move, which was larger than expected, is pretty much, so last year this time, that move was very close to what's currently being implied here. So, one begins to understand where the options pricing might be coming from. People are going to say, they're going to look at these things and say, all right, well, it's not just a question of how much it moves on average, but are some quarters more impactful than others? As you can see, the first 2 quarters in 23 saw larger moves, as did the first 2 quarters of 24. I'm being reminded to be careful when I say look here, look there, because as I whip my mouse around, the screen share is not keeping up. So important point there. But as you look at this chart, the one in the lower left, so regardless of whatever it is my mouse is doing, just notice that in the last 11 reported quarters, the 2 quarters each year that saw larger than implied moves were the first 2 within the calendar year, right? So I'm not talking fiscal year here, I'm just saying calendar year. So it was in the February 23 and February 2024 earnings results, and then the subsequent ones 3 months later in May. Those were the ones that actually saw the outsized moves, and we are indeed in the first quarter in terms of reporting for 25. So something to think about there. Oh, and actually, I'm going to scroll up here. Let's take a peek. Let's take a look at the stock. So this is the number. Oh, good. Okay, it's holding up. It's showing. So this is the 12. So we're going back 12 quarters again. So it's going to be 11 quarters worth of data historic on the dotted line. And then the green line tells us where we are right now. So interesting, isn't it? We find ourselves spot, as of this moment, going into earnings, we are spot on the stock's average performance over a similar time frame in the preceding 11 quarters. I find that interesting anyway. So, yeah, there we have it. Okay, let's move on. Spicy barbecue. I put a 35.5, 37.5, 28th weekly Feb risky in MGM today. Reason why: large call buying on the 37.5s. Okay. Let's have a peek in. Let's look at all what's going on here. Oops. I didn't happen to notice that flow in MGM, but I believe you. So here's some of the trades that are going on here in MGM. Oops, why is it on Palantir? There we go. I'm going to go to net flow. So this is kind of an interesting one as well, thing to look at. So sort of a way to aggregate, think about all of the net premium outlay and so on. So this will show you the amount of premium net by strike. And so, oh yeah, okay. Yeah, I see what you're saying there. I see what's going on. Okay. Yeah, I kind of like the gaming stocks too. Let's see. I'm going to pull up something else here on this one. Oh, you know what I should do? Let's bring this back for a second. So we can sort of see what the analyst ratings have to say of late. Well, that's a little one-sided, isn't it? I gotta make sure I've got the right stock in here. That's unsurprising. Everybody's hugely bullish on NVIDIA. So we're waiting. My screen is lagging. What we're about to see in a moment. So average analyst target for MGM is up about 25% from here. It feels a little bit like Fletch, you know, when he's showing all the pictures when he goes on his scouting expedition to Utah. If this was at all legible, you'd see what I was saying. So we're going to wait just a second. This is going to show up, but you're going to get a sense of the targets in just a moment. It's still on NVIDIA here, I think. All right, yeah, this is a little bit annoying. We'll make sure we get this sorted out because I hate to drag it out. And there have probably been instances, I apologize for this because I didn't realize it. I'm being informed this time. But there may have been circumstances in the past where I was whipping around on my screens, not realizing that you all were not seeing what I was seeing. And now you are. Okay, I can see it. So what you are looking at right now are the analyst ratings for MGM Resorts. And if you draw your attention to the bottom of the screen, what you're going to see is that you can see the current stock price of 40.5 thereabouts relative to the average analyst price target of about 50, which is up about 23.6%. Stock's obviously been not hugely strong of late, but some of the numbers that we've seen coming out of the casinos recently have been respectable. So certainly we have in the sports betting. I mean, this is one of these things. I really hope that for the sake of these casinos, I hope that they don't give up all of their sportsbook business to the DraftKings crowd. It's kind of an interesting thing. It's a great business. When I was at Cantor Fitzgerald, this came up recently actually because my boss's boss, I guess we should say, Howard Lutnick, is now the Secretary of Commerce. And, people who had it in for him or whatever, they were making some criticisms about having run afoul of gaming filings or rules. Cantor Fitzgerald, the partnership that Howard runs, and effectively he's the owner, he's the GP, and all the rest of us partners were just limited partners. But he's a really entrepreneurial guy, and he got very interested in the sports betting business. And initially, when he did that, it's very easy to run afoul of Nevada gaming laws, because I can remember when I first got there that at some point they wanted all the partners of the firm, even limited partners, to fill out Nevada gaming application stuff. And I mean, it was just a huge thing. And we had thousands of employees, 6,000 employees, hundreds, maybe 1,000 partners of the firm. I mean, it was there's a lot of people, so it's very easy to run afoul of Nevada gaming stuff. But it's a great business. Cantor ended up running a big sports book in Las Vegas, and the casinos, the sort of the mainstream casinos that we think of, whether it's MGM, whether it's Wynn, LVS, and so on, for their sakes, they shouldn't push back too much on upstart sports books. Instead, they should probably just, because what ends up happening is then you end up getting left behind. So for their sake, they really should try to get on board with all of that. I think that is an important trend. As it happens, I think my former boss, Howard Lutnick, he's divesting from Cantor or something, or putting it into a blind trust. I'm not sure, but that's really if he doesn't go back to the firm, or if he really sells it, that's quite something, because he's one of the longest serving CEOs on Wall Street. He started his career there, I think, fresh out of college, went to Haverford, and guy became a billionaire. Quite a story. And even more impressive is that he's obviously had some material hardships, so not an important story to talk about his bio, but both his parents died, I think, when he had just started in college, and then his brother died on September 11th. Cantor Fitzgerald was the firm that was hardest hit. I didn't work there. I was a client of Cantor's. I joined the firm after, but remarkable. Now he's a Secretary of Commerce. So congratulations to him. All right. Tucker D. Dog. Jensen keeps saying people got impact of Deepseek wrong. I agree. I think that's true. First of all, the whole Deepseek thing, we did it for $5 million or $6 million, whatever that number was. No way. I don't know what they were counting, but that was not really achievable. So I think they had access to more chips, probably purchased by way of Singapore or something like that. Michael Anthony, I had Herbalife had great earnings, and my best investment buying up shares on the sell-off to be breaking out now. Yeah, I think I mentioned this one before. It's not a company I follow that closely anymore, admittedly. I think I've said this about the business. We owned this when in my Ivory days, was not part of my. I wasn't covering it. I want to make that point. But the guy I worked for, the PM, Herbalife was one of his larger holdings, and he did extremely well in it. I am not enamored of the multi-level marketing business, and particularly the way they're deploying it. Now, I mention this not because I'm trying to influence any of you who might be thinking, oh, well, that doesn't make a difference to me. Don't let my preconceptions about that business model impact you here. But it is worth noting that there's a lot of investments available out there. And if I run into a situation like this, where, what does Herbalife do? It's a multi-level marketing organization like an Amway, or what is the, what's the other one? There's a a women's cosmetics business, where you can get a pink Cadillac or whatever. I don't know if they still do that. But basically, you can sell products. They sell nutrition things, and the thing that they sell more of, in theory, than anything else is like a protein shake powder. And the issue I have is that, number one, you can buy protein shake powders in a variety of places, including going to the drugstore. But the way a lot of people who are successful selling this stuff, how they actually make their money, is they recruit other people to sell for them. That's why it's a multi-level marketing organization. I can go out and try to sell tins of protein shake powder, or I can go recruit people, 10 people, and say, you go out and do it, and then explain to them. But of course, if you go out and recruit 10 people and they recruit 10 people, suddenly, instead of just me selling it, there's 1,000 people selling it, because I found 10, and each of the 10 found 10 is 100 times the next 10 is 1,000. And that's the whole idea behind a multi-level marketing organization. And to me, if you're making your business by selling goods, that's one thing. But if you're making your business by, recruiting people to recruit people to recruit people to sell goods, it kind of gets a little away from, it doesn't really completely pass the sniff test to me. And like I said, that's a personal thing. You don't have to take it however you will. But when I find a business like that and I kind of feel a little bit icky about it, I skip it. Because there's a lot of stocks out there. And the beauty of it is, I'll leave you guys with this one thought, because I've squandered about an hour. But the beauty of that is that if there are a lot of people like me who say, I'm not going to touch it because I find it distasteful, the opportunity is probably going to be better for the people that do, because there's fewer people competing over the stock to begin with. So that can be a real benefit. Sometimes you want to buy things that are out of favor. And, not that my opinion on Herbalife this way or that really makes a huge difference, but it can actually create more upside or more alpha if you find value where others don't. So, and obviously in this case, and by the way, I think Mary Kay, yes, thank you, PC, brings it up. Mary Kay. Tupperware too. Makes me, I don't know if it was Tupperware, but I remember in Napoleon Dynamite, they were out there trying to sell some kind of industrial, storage stuff, and they ran over it in the van and then ran away when it broke. Funny scene. But in any case, as you see here, I remember you bringing up Herbalife not that long ago. It probably was had less than a 6 handle. Now the thing's closing on 9. So you've got, a 40% gain in a week or two or whatever it is. Well done. So it is important, just because when you guys hear me say, I don't care for it, that could be an opportunity rather than a reason to stay away. So congratulations. Nice trade. Nice trade for you. And with that, so just things to think about. Valuations matter. Valuations for a lot of these stocks are getting a little out of control. I have a feeling that NVIDIA's numbers are going to be quite good. I have a feeling, though, just because things feel heavy, that it's not going to break out to those huge upside gains that we saw in the first quarter of 23 and 24 for that one. On the consumer side, you are going to see people reveal things like the chart that I was showing in the beginning, and I happen to have it up now, which is dividing the credit card balances by deposits. You can't do that because deposits are held by one group of people and the credit card balances are held by another. Otherwise, and who would do it otherwise? No one's going to carry a $10,000 credit card balance and pay 23.5% so that they can earn 5% or 4% or whatever the number is on their demand deposits. So with that, subscribe, notification bell. If you're interested in unusual whales, we get a cut, you get a discount. I think we have a link in there. And we'll be back on Wednesday at 1:15 Pacific time and 4:15 Eastern time. As always, I appreciate your time and attention. Thanks for watching.